Now, if you've just purchased a property or you're refixing your mortgage or changing banks and you're making a new decision on how to set up your mortgage, then you're going to be making a decision around whether or not you're going to float or fix. What it means when you're floating is that chances are your interest rate is a little bit higher, especially if you're here in New Zealand, but you can make lump sum payments of any amount at any time off your mortgage without any penalty. On the other side of the equation, though, if your mortgage is fixed, what that means is that the interest rate is fixed or it's locked in over a predetermined period of time. Generally, that could be as short as 6 months, but it can be also as long as 5 years. How long you fix it for is absolutely your decision. Some people will give you advice on what you should do, but ultimately, my recommendation would be that you would understand why you're doing it and document it somewhere as well. If you adopt a passive refixing strategy, that means that you don't need to worry about the rest of this video, to be honest, because what you do is no matter what happens, you're always going to fix your mortgage for the exact same period of time every time a decision is required. Maybe that's 1 year or 2 year, or 3 year, or 5 years, whatever. If you make a decision that that's what you do, then don't worry about the rest of this video because it's a complete waste of time. All you need to focus on is the strategy that you've already agreed to. But there are many types of passive strategies, including interest rate averaging, including using offsets and setting aggressive repayment terms. They don't need to worry about interest rate risk so much. So there's a lot of stuff that you could talk to your advisor about, if that's us or someone else, so that you can get a lot of input and a lot of choice that works well with who your financial personality already is. But what I'm going to talk to you about in the rest of this video is an active refixing or fixing strategy known as the micro macro framework. So how does this work? Well, think about the next 5 years, first and foremost. Do you see any changes or any significant events happening to you or that you want to see happen in the world? If something like that is happening in the next 5 years, grab a bit of paper and just write down what that event is and when it's occurring. Will that event, when it occurs, cause you to want to change banks, repay a significant amount of debt off your mortgage, or repay it off in full, sell property or go overseas, turn it into a rental, whatever it is? That's what you're trying to do. What is the event? When will it occur? What impact will it have on the mortgage? Write it all down so that you can get a picture of what's happening in your micro universe, in your world, over the next 5 years. It's really important that we don't fix the interest rate on the mortgage for a period of time which outlasts a major event in your life that could cause you to potentially sell your property or repay your debt significantly. The reason why is because while fixed rates are generally cheaper in New Zealand, they come with a massive fishhook. If you repay them in full or in part before that fixed rate period expires, you might be up for a break fee, which could be a couple of $100 all the way up to $20,000 or $30,000. I've seen break fees over $100,000 in my career as a mortgage advisor. And you do not want to have a situation where you're paying $100,000 in break fees because you fixed for the longest period of time at the peak of the market and then you decided to sell your property next year. So make sure that you get your micro circumstances laid out nice and clear. Once you've done that, then consider the macro. The macro just means the big picture. Most of the time, we're preoccupied with what happens in our four walls or in our neighborhood or in our community, but we seldom think much bigger than that. And when we think about the macro, we're thinking about all the things that we can't affect in our lives and all the things that we are kind of subject to. Things like geopolitical tussles overseas, things like bank stability, things like property market, equity market, interest rate market, debt markets, all of these things which move in trends and cyclical patterns. These are the things that we are both subject to, but also not completely defenseless against. In other words, we can position ourselves properly so that we can prosper off of negative events or positive events. We just need to understand what impact they're going to have on interest rates and over what time frame. So to wrap this up really simply, we're going to consider all of the relevant and important things that's happening in your world. And then we're going to consider all of the stuff that's happening in the big wide world that we can't control. So what are some of these things that we are concerned about overseas? Well, the first thing is the fact that there just seems to be cycles and there seems to be trends. Some of those trends will be a secular trend that might span over decades. Some of these will be cyclical trends that might span over, say, 7 years, like the property market that tends to double over 7 to 10 years. That's kind of a cyclical trend that we see play out in the short term. But a secular trend might be something more akin to what happened back in 1971 when Richard Nixon fully took the US dollar off the gold standard. That really changed things in terms of how much government and central bank could influence the economy using the monetary system, using the financial plumbing that keeps the economy moving. So here we are 50 years later. We can see that trend. We can maybe see a couple of short term trends that are happening at the moment. And then we can see this trend where we get a significant war every 50 to 70 years as well. What does it all mean? Who knows? But that's the art. Can we figure out if this is going to increase interest rates or decrease interest rates? And if so, by how much? And then over what time period would we expect to see it play out? So once you've considered all your micro circumstances, we now know the limit in terms of how long you should be fixing your mortgage for, because any longer will trigger break fees, and that's nasty. But on the other side, how long should we fix for if there was no restrictions? Well, maybe we could consider when these cycles will play out so that we can track where we think the interest rate will be at some point in the future. It would be great to see if we could cut through the high interest rate times that you may see coming and ideally land at the low interest rate time, which will often happen at the peak of despair when central banks around the world lower interest rates again. That's assuming they follow the same playbook as last time. Now, it doesn't matter what your politics is, what you think should happen, or what actually does happen. And it doesn't really matter what the so called economists or financial experts suggest either. It doesn't matter. What happens in the world will happen in the world completely outside of anybody's understanding. If anyone guesses it right, it's just going to be coincidence. So be really careful anchoring yourself to somebody else's prediction. Try to build the framework that you can own yourself so that when you're fixing your mortgage, you have supreme confidence that you're not fixing it for too long, therefore triggering a break fee, or you're not fixing it too short, therefore coming off at a high interest rate time instead of a low interest rate time. Hopefully, this has helped you understand how the framework works a little bit. If you're getting mortgage advice soon around an upcoming fixed rate decision, this is the kind of framework that you might want to follow and build for yourself if you're keen to look at external events in such a way where you think, maybe I could benefit from this. Maybe I could actually maneuver myself in such a way where I'm fixing my mortgage for a long period of time when I see the highs coming and fix for a short period of time when I can see we're just about to fall off a cliff. That's kind of how it works. But again, if you've adopted a passive mortgage strategy and you've just watched this for entertainment purposes only, then you don't need to worry about anything that I've discussed here because you're just going to do the same thing every time. Maybe you've divided up your mortgage into 5 equal parts, and at the end of each fixed rate period, you just fix it for the longest period of time. Maybe you've arranged it in such a way which matches your after tax income or cash flows that you have coming in the future to allow for any lump sum payments without any penalties. The main thing is that you've gone through this really carefully, and ideally it's documented somewhere so that in the future you could look back at this and go, yeah, that's what I was thinking. Was I right? Was I wrong? Would I have the same view now in hindsight that I did back then? It's a great way to learn, if nothing else. So I hope you enjoyed that. Now, one last thing, if you've been watching and you want to get a copy of my latest mortgage strategy report, this one here is for 2024, then all you need to do is be subscribed to our newsletter. Link is in the description. You'll get that once a month, which is when I update it. I go over all the latest macro trends that I'm personally thinking about, and then I apply a weighting towards what I think is the most logical thing to do based on that. So if you want to get a copy of that, all you need to do is visit the link in the notes, subscribe to our newsletter, and then you'll get that whenever I update it. Hope you enjoyed that one. We'll catch you in the next one.